What if I told you that one man, a 94-year-old grandfather from Omaha, Nebraska, has quietly built one of the most powerful investment portfolios in human history? A man who does not use a smartphone, who still reads 5 newspapers a day, who eats McDonald's for breakfast and drinks 5 Coca-Colas before noon. Man who turned a $10,000 investment into over $100 billion. That man is Warren Buffett. And today, we are going inside his mind. We are not just going to talk about what he has already bought. We are going to understand why he bought it, what he sees that other investors miss, and most importantly, which 5 stocks are sitting at the very top of his $274 billion portfolio right now, stocks he would buy again in 2025 if he had to start from scratch. If you are serious about building long-term wealth, if you are tired of gambling on meme stocks and chasing trends, then stay right here, because this video could change the way you think about money forever. Let us get into it. Before we dive into the stocks, you need to understand the man behind them, because Warren Buffett's portfolio does not make sense unless you understand his philosophy. Warren Edwarji Buffett was born on August 30th, 1930, in Omaha, Nebraska. He bought his first stock at age 11. By the time he was 14, he had saved enough money from delivering newspapers to buy 40 acres of farmland. He studied under the legendary Benjamin Graham, the father of value investing, at Columbia Business School. And from Graham, he learned one simple but life-changing idea. The stock market is not a casino. It is a machine that sells you ownership stakes in real businesses. And sometimes, often because of fear and emotion, that machine sells you those stakes at prices far below what those businesses are actually worth. Buffett took that idea and ran with it. For 60 years, under his leadership, Berkshire Hathaway has delivered an annualized return of roughly 20%, compared to the S&P 500's 10%. That means if your grandparents had invested $10,000 into Berkshire Hathaway when Buffett took control in 1965, that investment would be worth over $350 million today. $350 million from $10,000. That is the power of Warren Buffett's approach. And today, we are going to break down the 5 stocks that represent his highest conviction bets and what he sees in each one of them. Now, before I reveal the 5 stocks, I need to give you the mental framework Buffett uses. Because if you do not understand this, the stock picks will seem random. Buffett does not look at a stock chart. He does not care about moving averages or technical indicators. He does not watch financial news networks all day. He once said, "I do not try to predict the market. I try to find great businesses." So what makes a great business in Buffett's eyes? He uses 4 core filters. The first filter is the economic moat. An economic moat is a durable competitive advantage. It is the invisible wall that protects a business from its competitors. Think about Coca-Cola. Anyone can make a sugary brown drink, but can anyone replicate 130 years of brand recognition? Can anyone build that emotional connection? The one where a person in Tokyo, Lagos, or Sao Paulo sees a red can and immediately feels something. That is a moat. And once that moat exists, it is almost impossible to destroy. Buffett looks for businesses with this kind of protection. It could be a brand, a network effect, low-cost production, patents, or regulatory licenses. Whatever form it takes, the moat must be wide and deep. The second filter is consistent earnings power. Buffett hates uncertainty. He wants businesses that generate profits reliably, year after year, regardless of what the economy is doing. He once described his ideal investment as a business that an idiot could run, because sooner or later, one will. That is not a joke. That is wisdom. He wants businesses so simple, so dominant, and so reliable that even bad management could not destroy them quickly. The third filter is honest and competent management. Buffett does not just buy stocks. He buys into partnerships with the people running those companies. He has said he looks for 3 qualities in a manager: intelligence, energy, and integrity. And he always adds, if they do not have integrity, the first two will destroy you. When Buffett invests, he wants management that treats shareholders like partners, not like a piggy bank. He wants people who are transparent, who communicate clearly, and who make rational decisions about where to put the company's money. Fourth filter is a sensible price. Even the world's greatest business becomes a bad investment if you pay too much for it. Buffett learned this from his mentor, Ben Graham, who created the concept of the margin of safety. The idea is simple. Only buy a business when its price is significantly below what you believe it is actually worth. That way, even if you are slightly wrong in your analysis, you still do not lose money. Buffett once put it perfectly. Price is what you pay. Value is what you get. Now that we have the framework, let us talk about the stocks. Stock number 1. Apple. Apple represents 22.6% of Buffett's entire $274 billion portfolio. That means more than 1 in every $5 Buffett has invested in the stock market is sitting in a single company, Apple. Now this surprises a lot of people, because for most of his career, Buffett famously avoided technology stocks. He said he did not understand them well enough. He watched the dot-com bubble and crash from the sidelines. While other investors were losing everything on tech speculation, Buffett stayed in his lane. So it changed. Around 2016, Berkshire began building a position in Apple. At first, many people assumed it was one of Buffett's investment managers who made the call, but Buffett later confirmed he was involved. And when asked why, he broke his no-tech rule for Apple. His answer was revealing. He said he did not see Apple as a technology company. He saw it as a consumer products company with an unbreakable ecosystem. Think about it from Buffett's perspective. Over 1 billion people in the world use iPhones. And the iPhone is not just a phone, it is a gateway to an entire world. The App Store, Apple Music, iCloud, Apple Pay, Apple TV Plus. Once you are inside the Apple ecosystem, it is extraordinarily difficult to leave. The switching costs are enormous. You would have to change your phone, your laptop, your music library, your payment habits, your photos, your messages, everything. That is a moat, a massive world-class moat. And on top of that, Apple has pricing power that very few companies on earth can match. When Apple raises iPhone prices, people still buy them. That is the definition of brand power. Let us talk numbers for a moment. Apple is one of the most cash-generative businesses in human history. In a recent fiscal quarter, Apple reported total revenue of $94 billion, a 10% increase over the prior year. Services revenue, which includes the App Store, subscriptions, and Apple Pay, continues to grow rapidly and carries significantly higher profit margins than hardware. And Apple is one of the biggest buyers of its own stock in the world. Every quarter, Apple returns tens of billions of dollars to shareholders through buybacks and dividends. Buffett loves this. When a company buys back its own shares, it increases the ownership percentage of every remaining shareholder, including Berkshire Hathaway, without them doing anything. As Buffett once put it, he loves when a great business buys back its own stock. It is like the company is working for you, even while you sleep. The lesson from Apple? Buffett did not invest because of the technology. He invested because of the customers. He saw 1 billion people who would never leave. And he asked himself, what is that worth? The answer, apparently, was somewhere north of $60 billion invested. Stock number 2, American Express. The American Express now represents 20.5% of Berkshire's portfolio, nearly as large as Apple. And Buffett has said that if he could only own 5 stocks for the rest of his life, American Express would be on the list. He has held this stock for over 30 years, and the story of how he first bought it is one of the most fascinating chapters in investing history. In the early 1960s, American Express suffered what became known as the salad oil scandal. A fraudster named Anthony D. Angelis had used falsified warehouse receipts for Salad Oil to borrow enormous sums of money from banks and brokerage firms. When the fraud was discovered, American Express, which had certified the collateral, faced massive financial liabilities. The stock crashed. Investors fled. Wall Street was writing obituaries for the company. But a young Warren Buffett, who was in his early 30s at the time, did something unusual. He walked into restaurants and diners around Omaha and watched what people paid with. And he noticed something remarkable, even in the middle of a scandal that had the financial press in a panic. Ordinary people were still pulling out their American Express cards without hesitation. The brand was intact. The customer loyalty was intact. The crisis was a financial problem, not a business problem. Buffett invested 40% of his entire partnership's capital in American Express. It was one of the most concentrated and bold bets of his early career, and it paid off enormously. Fast forward to today. Berkshire has been a continuous shareholder of American Express since 1991. The cost basis, what Buffett actually paid, was approximately $1.3 billion. Today, that stake is worth more than $40 billion. That is a return of over 3,000%. But what keeps Buffett holding and adding? Several things. First, the business model. American Express operates what is called a closed-loop payment network. Unlike Visa and MasterCard, which process transactions between banks, American Express acts as both the card issuer and the payment network. This means they have direct relationships with both the cardholder and the merchant. That gives them richer data and more control over the customer experience. Second, the customer base. American Express cardholders spend significantly more than average credit card users. They tend to be higher-income professionals and business owners. This makes a premium brand, not a mass-market commodity, and premium brands have pricing power. Third, the fees. American Express charges card members annual fees, and those fees grow every year. This creates a reliable, recurring revenue stream that does not depend on interest rates or the economic cycle. When Buffett looks at American Express, he does not see a credit card company. He sees a business that wealthy people voluntarily pay to be part of, year after year, for decades. That is a beautiful business. Stock number 3, Bank of America. Bank of America is Berkshire's third largest holding, representing 10.4% of the portfolio. Now, banks are interesting because many investors avoid them. They are complex, they are leveraged, and they can fail spectacularly, as the world saw in 2008. But Buffett has always had a deep understanding of banks. He knows that a well-run bank, with a stable deposit base and disciplined lending, is essentially a machine that borrows money cheaply and lends it out at higher rates. Over time, the math works powerfully in the bank's favor. The most important chapter in Buffett's Bank of America story began in 2011. That year was rough for Bank of America. They were still dealing with the fallout from the 2008 financial crisis. Billions in mortgage losses, legal settlements, regulatory problems. The stock had been cut in half. Confidence was low. Buffett called up the CEO and offered a lifeline. $5 billion invested immediately, in exchange for preferred stock paying a 6% dividend and warrants to buy 700 million shares of common stock at $7.14 each. It was a classic Buffett move. He steps in when others are running away. He provides capital when it is most needed, and in exchange, he gets terms that are extraordinarily favorable. By 2017, Berkshire exercised those warrants, acquiring 700 million shares at $7.14 each. Shares that were trading far higher at the time. It was, by any measure, one of the most profitable single transactions in Berkshire's history. Bank of America has one of the largest consumer deposit franchises in the United States, serving roughly 69 million consumer and small business clients. It is the second largest bank in the country by assets. And as the economy grows over time, A bank embedded that deeply into American financial life is positioned to grow alongside it. Now, it is worth noting that Buffett has been gradually reducing his Bank of America position in recent quarters. This is a reminder that even long-held positions are subject to revaluation. At certain prices, the risk-reward becomes less compelling, and Buffett is always watching. He is a value investor, not a buy-and-forget investor. Stock number 4, Coca-Cola. If any single stock represents the soul of Warren Buffett's investing philosophy, it is this one. Coca-Cola. Buffett began buying Coca-Cola in 1988. He paid a total of approximately $1.3 billion for his stake. Today, that stake is worth over $28 billion, and along the way, he has collected billions more in dividends. He has never sold a single share. Not in the crash of 2000. Not in 2008. Not during the pandemic. Not ever. To understand why Buffett loves Coca-Cola so deeply, you have to understand what Coca-Cola actually is. It is not a beverage company. It is a brand. One of the most recognized brands in the history of human civilization. There are an estimated 2 billion servings of Coca-Cola products consumed every single day in almost every country on earth, in cultures that speak different languages, practiced different religions, and eat completely different foods. The red can of Coke is a universal symbol. That brand has been built over 130 years, and it cannot be replicated. Buffett has often described Coca-Cola using a thought experiment. Imagine you had $100 billion and you wanted to build a competitor to Coca-Cola from scratch. Could you do it? You could build the factories. You could bottle the drinks. You could hire the sales force and buy the shelf space. But could you make people feel the way they feel when they see a Coke? Could you create that emotional connection built through 130 years of advertising, culture, and shared human experience? No. You could not. That is the moat, and it is essentially infinite. Now let us talk about what Coca-Cola has done for Berkshire Hathaway financially, because the numbers are almost unbelievable. Berkshire owns approximately 400 million shares of Coca-Cola. Coca-Cola pays a quarterly dividend, and they have increased that dividend every single year for over 60 consecutive years. 60 years of consecutive dividend increases. Through oil crises, through recessions, through pandemics, through wars, the dividend has gone up every single year. When Buffett first bought his shares in 1988, Coca-Cola was paying Berkshire about $88 million per year in dividends. Today, Berkshire receives roughly $750 million per year in dividends from Coca-Cola from shares it bought for $1.3 billion. Think about that for a moment. Buffett invested $1.3 billion. He now collects $750 million every year just in dividends. That is a yield on cost of nearly 60%. And he still owns the original shares, which are worth over 20 times what he paid. This is the miracle of long-term compounding with a great business. And it is why Buffett has said that Coca-Cola is not just a great stock. It is a lesson in what patient investing can achieve. Many investors look at Coca-Cola today and say, it is not exciting. It is not growing fast. The world is moving toward healthier drinks. And those observations are partially true. Coca-Cola does face headwinds. Sugar taxes, health trends, changing consumer preferences. These are real challenges. But Buffett does not care about what is exciting right now. He cares about what will still be here, still be dominant in 20 years. And when he drinks his 5th cherry Coke of the day, he's reminded the world's love affair with Coca-Cola is not ending anytime soon. Stock number 5. Chevron, the 5th and final stock in our lineup, is perhaps the most interesting because it reveals something many people do not know about Buffett's thinking. He is not afraid of energy. Chevron, America's second largest oil company, Berkshire's fifth largest holding at 7.2% of the portfolio, a position worth nearly $20 billion. But much of his career, Buffett was cautious about energy companies. The challenge with oil and gas is that the underlying commodity, crude oil, is priced by global markets, and those prices swing violently based on geopolitics, OPEC decisions, and macroeconomic factors completely outside any company's control. So why did Buffett buy Chevron, and why has he been adding to his position? The answer has several layers. First, energy is not going away. Despite the rapid growth of electric vehicles and renewable energy, the world still consumes approximately 100 million barrels of oil every single day. The global economy runs on fossil fuels, and that is not changing overnight. Even the most optimistic projections for the energy transition suggest that oil and gas will remain essential for at least the next 2 to 3 decades. Second, Chevron specifically is one of the most financially resilient oil companies on earth. It has one of the lowest break-even costs in the industry, meaning it remains profitable even when oil prices fall significantly. It has a strong balance sheet, and it has returned capital to shareholders consistently through dividends and buybacks for decades. Third, and this is the one that Buffett has hinted at in his letters, energy is a powerful inflation hedge. When prices rise broadly, energy prices tend to rise too, and a company like Chevron, which sits at the very source of the energy supply chain, benefits directly. Chevron has paid and grown its dividend for over 35 consecutive years. It currently pays one of the most attractive dividends in the Dow Jones Industrial Average, and it regularly repurchases its own stock, reducing the share count and increasing the value of every remaining share. Buffett has said he loves companies that return cash to shareholders. A dividend and a buyback are both ways of saying we have more money than we need, and we want to share it with you. Chevron does exactly that. And as long as the world needs energy, which will be for a very long time, Chevron will keep generating the cash to do it. Now let us step back and look at what these 5 stocks: Apple, American Express, Bank of America, Coca-Cola, and Chevron tell us about how Warren Buffett sees the world. The first lesson is that concentration beats diversification. If you know what you are doing, these 5 stocks alone represent nearly 70% of Berkshire's entire $274 billion equity portfolio. Most financial advisors tell you to diversify, to spread your money across hundreds of stocks. Buffett disagrees. He has said, diversification is protection against ignorance. It makes very little sense if you know what you are doing. His point is not that diversification is bad. His point is that if you have done your homework, if you truly understand a business, its moat, its management, and its value, then owning a lot of it makes more sense than owning a tiny bit of everything. The second lesson is that time is the investor's greatest asset. Buffett has owned Coca-Cola for over 35 years, American Express for over 30, Apple for nearly a decade. These are not trades. These are partnerships. The magic of compounding only works if you give it time. A great business held for 30 years will do things for your wealth that no clever trading strategy can replicate. The third lesson is to buy. Fear and sell greed. Every stock on this list was either bought during a period of uncertainty or held through one. Buffett bought Bank of America during a crisis. He bought American Express during a scandal. He bought Apple when it was being written off by many commentators. The lesson is simple. The best time to buy great businesses is when everyone else is afraid to. As Buffett famously said, be fearful when others are greedy, and be greedy when others are fearful. The fourth lesson is to understand what you own. Buffett never buys a business he does not understand. He does not chase trends. He does not speculate on biotech or meme coins or the latest artificial intelligence. Startup buys businesses he can explain in one sentence. Coca-Cola sells beverages that people love. American Express serves wealthy customers who pay to be part of their network. Chevron produces the energy the world runs on. Simple, boring, brilliant. So there you have it. The 5 stocks Warren Buffett would buy in 2025, backed by decades of philosophy, patient capital, and an unmatched understanding of what makes a great business. Apple, American Express, Bank of America, Coca-Cola, Chevron. These are not tips. They are not hype. They are the holdings of the greatest investor who ever lived. A man who has spent 70 years proving that the path to wealth is not complicated. It just requires patience, discipline, and the courage to buy when others are running away. If this video helped you think differently about investing, leave a comment below. Tell me which of these 5 stocks you think is the most interesting. I read every single comment. And remember, this video is for educational purposes only. Always do your own research before making any investment decisions.